All right, police officers out there, today we are going to peel back why you should retire. There's no reason for you to stay on because of healthcare. You have an affordable option out there if you would just learn how these plans work.
So this week we're going to talk about insurance, specifically retirement insurance. Mario's going to give me a little lesson on why the things that we're offered in retirement actually might be better than stuff you can get out in the open market. So this will be a very interesting one. Might break some misconceptions you have about what you have access to and what you should take. Looking forward to it.
Welcome to the Cedar Harvest Show, where we focus on financial education for a variety of things that affect not only your life, but also your spouse, children, charities, and your legacy. We discuss everything from health insurance to pensions, wills and trusts to the best way for everyday tax planning. Our intention is to bring financial and legal professionals together with everyday people who need their help. We have real conversations with real people who have real questions and scenarios. I'm your host, Mario Lizarraga, and today's show is part of our law enforcement series. So I'm so happy to have our co-host, Officer Ty, welcome, who is an 18-year law enforcement officer currently employed here in Arizona. Our show is to help law enforcement officers understand their government benefits to the fullest extent possible, and then what happens after retirement. Today, we're going to continue our conversation about health insurance. Yay, health insurance.
Yeah.
Welcome back, Officer Ty. Here we go. Another run, brother.
Yep.
Okay, well, here we go. The joyous conversation everybody beats down my door about, being a health insurance agent that I am.
So say this is your wheelhouse now.
This is truly my wheelhouse for the last 12 years. So today I get to understand a little bit more about the pension side, what you're offered at work after retirement. Okay. So I know that's been a big question in talking to a variety of not only from firefighters, retiring firefighters, cops as well. It's a big concern.
Yeah.
And I've been surprised how many times that I've heard these words that I've got to keep working for health insurance purposes.
Yep, it's true. I mean, that's a lot of the people I talk to.
Well, I'm going to tell you after this conversation, I think I'm going to debunk that. Okay. I don't think I agree with that statement now that I've seen what you have access to.
Okay.
I really believe after seeing this that conversation is because everybody's so wrapped up in the word deductible and out-of-pocket maximum.
Okay.
And because people truly don't understand how health insurance works, they typically say the same line. I hear it from everybody, especially anybody who's a government or corporate employee who come from the world of a very robust, good group plan.
Yeah.
Right? Because that's one of the best perks of working for corporate America.
Yeah, okay.
Right? Is you get these low deductible plans, low out-of-pocket maximum, and so that's what we feel is we're protected.
Yeah.
And what that low copay. I talk people off that ledge all the time.
Okay.
Because when people come into my office, and I deal with mainly self-employed individuals or people who are getting away from their government or corporate job, and I always know that I have to start off by saying, hey, look, this is going to be a tough conversation for you because you've been mentally trained one direction.
Yeah.
But when you stop and you look at what you pay, when you take a more business-like approach, an annualized approach to your healthcare costs, you're going to see the way you've been trained doesn't make sense. Okay. And so I think this is going to be a very pleasant conversation for people retiring. It's not as dismal as you think. It can be extremely dismal if you stick with this low deductible, this low out-of-pocket maximum plan that I'm referring to. It looks terrible. Very few scenarios that I can think of would it pencil. And we'll see. I'll show you the numbers of what I'm referring to.
Okay.
I do have it pulled up on my computer. A couple things. I've got, we have your handbook pulled up.
Okay.
PSPRS.
Yep.
We also have your actual 2025 offerings.
Okay.
Okay. And so I did spend a little bit of time going through and at a high level trying to understand it.
Okay.
I really am reluctant to, speak to it, definitively in certain areas because I'm guaranteed there are little loopholes, little black and white scenarios that we really need to have somebody from PSPRS here.
Yeah. Okay.
And so I know you've reached out to them, and so hopefully they'll be agreeable to come on the show, and just to highlight the pros and cons of the plan.
Yeah.
And I hope they get to see this video, and I can tell you as somebody who's out there slinging health and life insurance every day to a lot of people, what you're offered in retirement is good. right? And people don't understand. And when you see, when I'm about to show you compared to Obamacare, it's a fantastic plan. Okay. Which is great.
Yeah.
So don't be so scared about retiring. All right. Let's start with the basics of health insurance. Okay. So I did this to you last time, and so you're already trained, so it's not really fair to ask you this question this time. I wish you were a rookie when it came to health insurance, but I've already ran you down this path. But let's do it again. Let's just say that, heaven forbid, you were hospitalized and for a few days, and you came out with $100,000 bills, accident, illness, whatever it is. Let's just say you're in a $2,500 deductible plan, and you're in an 80/20 coinsurance. Of that $100,000, if you're in a $2,500 deductible plan, 80/20 coinsurance, and let's just say you have an $8,000 out-of-pocket maximum, how much of that $100,000 are you liable for?
See, we talked about this a while ago.
Good. You don't remember.
I don't remember really. Awesome. 8,000. Was it 8,000 is the most you...
Yeah, but you're right. So most people would say, okay, we start with the $2,500 because that's what you're on the for the deductible. We're all on the deductible phase, which is phase one, what I refer to as phase one.
Yeah.
So that leaves a balance of $97,500.
Yeah.
Right. And then you're in the 80/20 coinsurance. So how much of that $97,500 would be yours in an 80/20 coinsurance? Most people I talk to would say, well, I think the insurance company picks up 80% and I'm on the hook for 20%. So most people would say 20% of $97,500. So they think they're on the hook for another $19,000 and change.
Yeah.
And that is not the case with any of these plans. And so this is the big scare tactic, because where these plans are so confusing that people really they buy their way into a plan that they feel is good insurance.
Yeah.
Right. And that's where they feel this low deductible plan makes sense. And it doesn't, because to your point, what you said, $8,000 is the most you're on the hook for. So, of that whole $100,000, and they'll finance you for that. It's not like you have to stroke a check for $8,000. They'll put you on a payment plan.
Okay.
Do you finance cars for $8,000?
I mean,
so yes,
you can, yeah.
But do you?
Have I? No.
You've never financed a car for $8,000?
I don't think so. No.
Okay, but you would finance your life, is my point.
Yeah.
If you're going to finance a vehicle, you're likely okay with financing your life.
Oh yeah.
It comes pre-financed. You don't need a credit check. They'll put you on a $300 a month payment plan for that $8,000. Reality is, the health insurance company is going to cover the bulk of the bills. After $8,000, the insurance company is going to pay 100%. And people lose sight of this within their plans. And that's why they end up spending way more for insurance than they should. I recommend to everybody, take the cheapest monthly premium plan you can get your hands on. All right? Because statistically speaking, if you're a healthy individual, your likelihood of maxing out your plan is very low. Okay? You're typically always going to be, or on average, statistically speaking, because it's gambling, it's insurance.
Yeah.
You want to take the biggest risk. Well, don't buy insurance. Save all the money. Right?
Yeah.
Take the ultimate risk. You want to lessen your risk a little bit, just take on a plan that has a stop loss, that has a ceiling, this out-of-pocket maximum. If you can get something $8,000-$10,000, it's highly unlikely you're going to hit that number, right? So save the monthly premium, and I'll show you what I mean by that. And you're going to be like, oh, yeah, that's a no-brainer. But because people are duped to thinking that they're going to be on the hook for 20% of infinity, so they're thinking, I'm going to be in the hospital for $200,000, $300,000, $1 million worth of events. So they're thinking, oh my God, it's going to wipe out my 401k of $200,000. That's not the case. You can be in the hospital for $2 million. You can be in a coma for 6 months, rack up millions of dollars in bills, and you're only going to be at a loss of $8,000 for 1 year. Okay. So the thing is, if you were in the hospital,
if you're in multiple years,
you just double down.
Okay.
It does. So people get unfortunate if they're unlucky enough to jump in and get hospitalized on December 27th. They're going to likely hit their out-of-pocket maximum for that year, December, and then it starts over January 1st. And that's a bummer, but that will happen. So you could potentially be on the hook for $16,000 with the scenario I just described.
So really, when you're looking at this stuff, you should be looking at the out-of-pocket maximum.
Correct.
And most people don't do that, is what you're saying.
That's what I'm saying.
Okay.
And that out-of-pocket maximum usually includes all of your drugs. So even people that have chronic illnesses, right?
Yeah.
They just know they have a stop loss in place. So what I do is I take an annualized approach. I multiply the premium times 12, because every month you got to make a premium.
Yep.
And then I add the out-of-pocket maximum, say this is your worst case scenario for the year. Worst case scenario, you're going to do this. Best case scenario, you're going to pay this monthly premium. And many times what you're going to see is it doesn't pencil to pay the additional monthly premium, right? Just so you can have a lower out-of-pocket maximum.
Gotcha. Okay.
And I'll show you. We'll do the numbers.
Okay.
You have it. It's right here. So that's kind of the really the big lesson that once I talk people off the ledge, they're like, oh, they feel so much better.
Yeah.
Right. But they just don't realize that there's a stop loss. There's a ceiling. And what they've got, people need to understand, that's why the cost of insurance is so much here. Because the reality is the insurance company is on the hook for millions of dollars.
Yeah.
I had a college friend of mine, his poor little girl, when she was like around 3 years old, was in the hospital for over 6 months. I've never seen so many tubes coming out of a human.
Yeah.
Reality is she racked up $3 million in bills, but she's alive to this day, and they had to pay about $10,000 out of their pocket. So that's what our American, healthcare system provides for people. So they get really upset. And it's usually the people that are healthy that are upset.
Yeah.
People that are using the benefit are pretty happy. So, and just to uncover that misnomer there of how health insurance is priced. Health insurance is priced based off of the group that you're affiliated with. Okay. So in this case, PSPRS.
Yeah.
Retired cops, right? We've talked about this in prior episodes.
Yeah.
The life expectancy on average for the male police officer is 67 years old.
Yeah, it's not. Yeah.
So when you guys get into your later years in life, I'm sure that there's probably statistically a few more claims than the average 62-year-old.
Yeah.
Right? I'm willing to bet. I don't know that, but that would be my
Well, I mean, it
assumption.
makes sense because they, police and fire, it's cardiac, or much higher than the average person. Like, that's usually what they die from. You think career full of stress and working, bad shifts, working third shift, whatever. So you're getting poor sleep and a lot of different factors. And, they always say that's one of the big ones is cardiac events. And
see, and I always think of it as that you guys, I assume you're going to live longer because you're working out, right?
Yeah, but
I guess but if you think about it, there's a lot of police officers that are out of shape.
Yeah, there's more than a lot. There's a majority,
unfortunately,
because at least most of the departments here, it's not a requirement to stay besides the academy. There's certain details that you can go to that have requirements to stay in shape, but for your every, patrol guy or even just like normal detective spots, there's no incentive and there's no requirement to stay,
So even a guy like yourself who does keep himself in shape, you still have the flip side of the stress of the job, the sleep deprivation.
Yeah, I mean, when you would the third shift, it's not normal for humans to be up that time of the night.
I don't know how you guys.
You're awake when your body is thinking you should be asleep, and then you add on to. I mean, it's the shift work disorder is a legit thing, and then having, added on the stress.
Then you got to go to court.
Yeah,
so you sleep for a couple hours. You have to be at court for something.
Or if you work on the weekends too, you're working weekends, and then you got to come, and then you have to your normal days off. You got to be coming into court. At times when you'd normally be sleeping. So yeah, third shift can be rough on people. Same with second shift.
Well, hats off to you. Thanks for doing what you do. So let's jump in and take a look at some of the numbers, and I'll show you why I don't think it's so dismal for you.
Yes. Okay.
So on the screen here, what I have, we're going to come back and look at. So basically, we'll just talk about it now. This is for, let's just say somebody leaves the department and let's talk about their options.
Okay.
Right. If you were to leave, I have up my, being a broker, I have backdoor entrance into Obamacare through this platform, Health Sherpa. This is the screen that we're looking at here. And basically I just put in here for 2 6-year-olds, and I can put whatever age you want. I just put a 2 6-year-olds, a male, female, a couple, okay, husband, wife, right? And you can see here the cheapest plan. There's 45 plans available. This is off exchange because you're going to make too much. People think Obamacare is an insurance plan. It's not. It's a subsidy program.
Okay.
Right. And so Obamacare is there to help offset the monthly premium cost and then also help cover some costs within the plan if you financially qualify.
Yeah. Okay.
Okay. I would say from what I'm seeing with these pension values and spousal income and second careers and side hustles, you're not going to qualify for anything. So these numbers here, I just went off exchange, meaning I bypassed the government.
Okay.
And I went directly to, in this case, UnitedHealthcare.
Okay.
And actually just off exchange. So there's 45 plans that you would have that we could go shopping on. The cheapest plan for a 60-year-old couple is $1,300. Okay, $650. That's a $9,100 deductible plan. That's a $9,100 out-of-pocket maximum. There's no co-pays. You have no co-pays. You're going to pay full boat for everything until you get to $9,100. This will crush a government employee's and corporate guy's soul when they see this. This is the devil plan because you're used to having those $20 copays,
Yeah.
all sorts of bells and whistles. And the only bells and whistles that this thing has is you have preventative care covered 100%. Outside of that, you don't have a benefit really. Well, you have network repricing, wholesale repricing because if you stay in network. But outside of that, this plan doesn't really bring a lot of value until you get hospitalized, until you have a big event.
Gotcha.
Then you have that ceiling, that safety net in place of $9,100. So if you were going back to our original example, you had the $100,000 event. This plan, you're going to be tickled pink because you only owe $9,100.
Yeah.
Okay.
But if you're reasonably healthy, no issues, then I could see where it'd be like,
oh, this would be a rub. Any MRI, you're feeling something in your gut, they give you an MRI, you're on the hook for that $1,200.
Yeah.
You get stitches, you go to the ER to get something looked at, $2,500. It's just, this plan's going to nickel and dime you.
Yeah.
And you're going to be very frustrated with this plan. You're going to call me like, what in the hell did you get me into here?
Yeah.
Right. And you're going to hate it. And so I try to talk people out, but that is in reality, that is the cheapest plan. It goes up from there. So as I take a look, it's just going up, clear into the most robust plans, what are in the gold plans, which are going to be, look at that, 2 people. You could pay as much as $3,760 a month for you and a spouse. That plan is offered out there. This is a $2,500 deductible, $4,500 out-of-pocket maximum. So the benefit of this plan is it's one of the ways you can get to Mayo Clinic. Yep, you can get to Mayo with this plan here, but it is a PPO. This is on Blue Cross Blue Shield's biggest network. Okay. And when it comes to buying health insurance, what I explain to people, you never want to hear the words, the person who can fix you is out of network.
Yeah.
Right. So I always tell people when you can afford it, buy the bigger plan, because when the time comes and your life is on the line, your loved one's life is on the line, are you really going to care that you spend an extra $6,000? You're going to kick yourself for not spending it.
Yeah.
Right? Pay the money for this purpose because you want to get to the specialty doctors, and the specialty doctors likely don't affiliate with the cheaper plans.
Yeah.
So I would never recommend this to anybody, okay? Because that same $100,000 incident, right? You're still going to pay $4,500 instead of $9,100.
Yeah.
But now all of a sudden you paid, what, $2,500 more per month?
Yeah.
Right? You just paid $30,000 more in premium. Am I doing my math right? $2,000, yeah, about $30,000 more in premium, monthly premium, just so you could save $4,500.
Yeah.
Makes no sense. Okay. So that's kind of the scenario. I just want to show you the high end, the low end and the high end. I usually very seldom pick the cheapest plan, and I never go to the most expensive ever. I'm typically going down a few notches down here to some of these other plans on the cheaper level. But let's jump into what you're offered. Okay. So let's talk about that. Let's hear this doom and gloom that everybody's talking about. So first off, everybody, we're pulling information directly from the PSPRS member handbook. Okay.
Yep.
So when you do retire, you do have a few options. As you can see here, you have a couple things: an extension of employer's health insurance as a retiree, if offered by the employer.
Yeah.
Okay. You do have access to COBRA, and that might make sense for the spouse, right? Sometimes there's a reason that if there's a divorce situation and they're in the middle of cancer treatments and their doctor's in network, just so the spouse would have an option to take the COBRA. Okay. So this is where COBRA can kind of come into play. COBRA was very popular pre-Obamacare because with Obamacare, the one beautiful thing about it is it's guaranteed issue. So whether you're a type 1 diabetic, you're in the middle of cancer treatments, you're a 750-pound man eating Twinkies every day, they have to take you.
For COBRA.
For Obamacare,
okay.
COBRA group plans.
Oh, okay.
That's why all those plans are so expensive.
Yeah.
Because the health insurance company has to take on the liability. The only thing that they can upcharge for is your age and where you live.
Okay.
And that's how health insurance is priced. I started talking about that. Depends on the group that you're affiliated with and geographically where you're located.
Okay.
Claims in that area. Okay. And then you can see the third one here is the ASRS Group Retiree Insurance Program. So we're going to talk about that. A few things that were kind of interesting, and that's this chart here. It took me a little bit to understand what was going on with this. Basically, if you retire, you do your time, they supplement the cost. So basically the group UnitedHealthcare is who you guys work through. Okay. And basically the state UnitedHealthcare has developed a pricing structure for everybody that works there within the system.
Okay.
The state has obviously said, hey, we're also going to we're going to throw you a bone too as a thank you for working for us. And they provided a little subsidy.
Okay.
And you can see that. So this subsidy here, you can see, and it's based off of, you get $150 for member only, assuming you're not Medicare eligible.
Okay.
So you're not eligible for Medicare until you're either 65 or you're on disability, long-term disability.
Okay.
Okay. That's what triggers Medicare early for people. So other than that, you're out there with regular schmoes like us if you choose to go outside of the system.
Okay.
Okay. But if you stay within the system, they're saying, hey, we're going to give you $150 for a member-only plan. And you can see if they do, they'll do $260 for a member and a dependent if no one's Medicare eligible. And then as soon as you are eligible for Medicare, then these numbers start dropping. So when you can see here, member of the department is in Medicare eligible, but your spouse, let's just say you're 65, but your spouse is 63.
Gotcha. Okay.
All right. So they're not going to give you as big a subsidy because Medicare picks up a lot more.
Okay.
Okay. And that's why they do that. So there's some interesting things in here. There's also, as I was reading through this brochure, it's interesting. So if you retire early, there's some different aspects. This is where I'd love to have PSPRS in here to kind of drill down a little bit more. I don't want to misspeak on any of these things.
Yeah.
Because the devil is in the detail. When it comes to insurance, I tell everybody, buy it for what it is, not what you want it to be. It's black and white, right? It is what it is. People lose when they're making emotional decisions.
Yeah.
Right? Just take a look at it, understand it. Again, it's never going to be what you don't want it to be. All right? It's going to be what they want it to be, and that's it.
Yeah.
And that's what's great about the black and white, because that's where the law comes into play.
Okay.
Right? If you have a problem, they're denying your claim, black and white, that's called a lawsuit.
Yeah.
Which is why I never recommend the ministry plans.
I don't even know what that is. What's a
ministry plan? Is just they have plans out there that are just for people who affiliate. They say, hey, I'm Christian, and there's plans because they've attested to being Christian. They've joined this group of Christians. So it's kind of like an Amish-based, community-based plan where everybody pays into this war chest, right, for healthcare purposes, and then there's a board that kind of governs the war chest. And then as you submit a claim, the board says, okay, that's legitimate, we'll pay it. Or they say, no, it's not legitimate, right? They are the law in that situation. Law does not apply. So you can't take them to court.
Oh.
It's not insurance. And that's why they have to list themselves as a ministry plan, faith-based plans. They can't even list themselves as insurance because insurance has legal recourse. All right. So, but this was really interesting I'm not going to drill down on this conversation. I would love to drill down on another episode.
Okay.
I basically I'm on the medical coverage enrollment form. Okay. And this is just basically what the form that you guys have to fill out if you're going to apply for something. On this form, it shows the various pricing tiers. Okay. So you can see, and then it also says the different plans, the premier plan versus the value versus the economy. Okay, and you can see for a single person under the Premier plan, it's $1,300 a month. That's just for you. You could choose this plan. Opposed to if you do the Choice Economy plan, only $660. So that's a $630 a month difference just in monthly premium. So $630 times 12 is going to be right around $8,000 because 600 times 12, $7,200. So that's actually about $7,600 difference in monthly premium alone, by you choosing to take this $1,290 plan over this economy plan. It's part of the reason I'd never recommend these plans, the lower
one.
And I'll show you why here in a second. So to me, when I see the lower price plan, typically they're changing the network of providers, which is a big deal. In these plans here, for you guys, they don't. The network is the same for all the plans. So that's amazing.
Yeah.
So when I see that, I always default to the cheapest plan.
Okay.
Always take on more liability. The more liability you take on, the lower premium. It's kind of like, think about your car insurance. If you raise your deductible level from $500 to $1,000, your rates go down.
Yeah.
The longer it takes the insurance company to kick in, the cheaper you're going to pay as a consumer. Because you're telling them, hey, I'm going to be more responsible because I know that I'm going to be on the hook early on. Okay. So you can see now with a family, $2,600 opposed to $1,320. Huge difference.
Yeah.
Oh my God. That's $1,260 a year. A month times 12 again. That's $15,000 a year in premium difference alone.
Yeah.
So when I see these numbers guaranteed, most people are wired for that low deductible plan.
Yeah.
And so that's why they get chased off, and I could understand. And that was the first text I sent you. I was like, oh my goodness, his prices are egregious. I text you that.
Looking at the top one.
Looking at the top one.
Yeah.
And as I started drilling down and understanding how the plans work, because I assumed that this was going to be a different network on the cheap plan. It's not. You still have access to the same great network. Okay. So you can see the different costs. And then if you did have family independence, still on the plan, if you were an older, older parent,
Yeah.
there's plenty of 65-year-olds who still have under 26-year-olds at home.
Yeah.
You're looking at $3,600 for the family opposed to $1,848. So that's $1,800 a month difference. Insane.
Yeah.
Okay. So that's just to give you kind of a quick little snapshot of pricing and how this works. So let's go in and actually look at, now we're going to go into the medical plan comparison. I just want to see where we're at. We're on the health insurance enrollment guide. Okay, for 2025. So this is going to adjust every single year. So I'm just drilling down to, and let me go up a little bit more before I go into this. Up here is where you see, regardless of the choice premier, the choice value, or the choice economy, it's all the nationwide network right here. Okay. So you have UnitedHealthcare as a nationwide network, and it's checkmarking all of them. So it's the same network regardless of what plan. So again, when I see that, that's all I care about. I want to make sure you have access to the best care you can possibly find when the time comes. That's all I care about as an insurance agent. I don't want drama. I don't ever want to have anybody call me if they can afford it.
Yeah.
Okay. So let's go in and take a look. And there's a lot of benefits. And again, I'm not going to get into the ancillary benefits that are embedded in the plan, but there's a lot, right? Gym memberships and virtual doctors. And there's a lot of little bells and whistles that you currently have, whether you use them or not. They're there. And in retirement, they're going to be there for you as well.
Gotcha. Okay.
Currently, who knows what's going to happen? So let's just zoom in here a little bit and let's take a look. So here you can see those same prices up top. Here's the premier, the choice value, and the choice economy. And you can see the prices for the single versus the single plus one versus the whole family. Okay. Which 10 kids, 2 kids, 1 kid, doesn't matter. They're charging the same. So this is where if you have a big family, it's to your advantage. But you can see here the major difference. Now that we know that it's all the same network, let's look at the deductible. Individual on the 6-expensive plan, $500 deductible. And everybody typically gravitates, get that low deductible. I know you've said it.
Yeah.
Right? Because that's what they think. That's the good plan. They want the low deductible.
Yeah.
They don't do the math. So they cost themselves hundreds of dollars a month, even at a young age. I did it. Young family, perfectly healthy, 2 kids. Uncle was a doctor right across the street, so I didn't need a copay. I would just text my uncle, hey. Sydney split her head open, pushing back, and she did, and she needed stitches. He came over to the house and stitched her up. So we didn't need the upfront benefits because we had a family doc right there. And so it was really silly, but even still, we still said, hey, go online and find the best plan. So we got the fully loaded plan, low deductible, maternity coverage, mental health benefits, everything we could. We threw it in there because we were scared.
Yeah.
We bought out of fear. And so because of that, paid $1,400 a month when less than like 27 years old, paid $1,400 a month for 4 years, never used the plan once, not even for a copay. And so UnitedHealthcare got $64,000 and we didn't get a nickel of benefit.
Yeah.
So we're fortunate. We're healthy. So we're blessed in that sense. So let's go through here. So you can see here, $500 deductible. Now let's go down to this next plan, choice value, the middle plan, $4,000 deductible versus now the choice economy, $5,250. People see that number like, oh no, they get scared.
Scared off right there.
Right. But let's do the math again. Well, actually, before you do the math, let's take a look at these. The biggest thing that we care about, which is out-of-pocket maximum. Individual out-of-pocket maximum for the best plan is $4,000. Getting back to that $100,000 event that we talked about.
Yeah.
Under the most expensive plan, you're still on the hook for $4,000. Right. Next plan down, you're on the hook for $6,000. It's not a big difference, $2,000.
Yeah.
Right. And then the cheapest plan, you're on the hook for $8,000. The insurance company pays 100% beyond that. Okay, so now let's do the math. So let's just say right now, because you're single, $1,300 times 12. What's the math on that? Roughly 12 times 13. My math isn't working right now. That's around $15,000, we'll say. Let's just do some good math.
Little computer there.
Yeah, so we got 12, what is it? 1290 times 12, $15,480.
Okay.
Okay. And so if you max out, the worst case scenario into this plan is you're going to spend the $15,480, okay, plus the out-of-pocket maximum. So that's going to put you at so you have a personal liability to your household, if you were just assuming you were one person, of $19,480.
Okay.
All right. That's your liability out the door. Worst case scenario. Heaven forbid. Now let's take a look at this cheapest plan. So the cheapest plan is $660 a month times 12 equals $7,920. Same worst case scenario, add in $8,000. $15,920. Which one makes more sense?
Yeah.
Do you want to bank on being sick and costing yourself even more money? And even if you're banking on being sick, you're still better off using the high deductible plan.
Yeah.
Right? Out the door. And this is what people don't realize. They don't understand this trick.
And like you said, with these, nothing changes as far as who you can go to. So you're not benefiting by.
No. And as we start drilling down, because I could really spend some time in here, so there is a family deductible. So it's just let's just do the math quickly for a family of two. Let's say a husband, wife, right? You're married. So $2,580. So $2,580 times 12. Okay. Almost $31,000. Heaven forbid you're both in the same car wreck, hospitalized for a few days, $100,000 worth of bills. You're going to max out. There's a family out-of-pocket maximum of $8,000. So basically your ultimate liability in this plan is $38,960 if you went with the most expensive, opposed to worst case scenario down here, $1,320 times 12, $15,840 in premium. Plus, now we have a maximum out-of-pocket maximum of $16,000, $31,840. Still considerably cheaper.
Yeah, still cheaper.
Right? Oh, way cheaper. It just doesn't pencil. It doesn't make sense. So as we start now, so what are you sacrificing for that? You're also sacrificing, okay, great. You get $40 copays to see the doctor on your most expensive plan. All right, so good for you. You just paid. That's what I showed people. Like, do you really want to pay $6,000 more a year in monthly premium just so you can save $40 to go to the doctor? How many times do you go to the doctor a year?
I mean,
twice?
If that even. I do my, checkup once a year, and then.
So let's say you're having a bad year. You're really sick. You got to go 5 times. Okay, yeah. So you just save $40 5 times, $200.
Yeah.
You saved in copays.
Yeah.
And you paid $6,000 extra, or whatever that number is, in monthly premium. So you do have higher copays. Okay. And then you can see, and that's for the primary care, and then specialists, instead of paying $100, you pay like $160.
So what, with that one, with like the family, what does that mean underneath it? We're saying 100 copay and then 50 copay tier 1. What's that?
I'm assuming it's that the $40 would be for the spouse, and the $20 probably for the tier 1 employee.
Gotcha.
This is where I would like some clarification myself.
Yeah.
Because it doesn't say. That would be my best guess what they're meaning there.
Gotcha.
But I could be totally wrong there. That could just be $40 copay for tier 2 and tier 3. Right? Maybe so maybe just because you are tier 1. So actually that would make sense. That probably is for anybody who's non-tier 1.
Okay.
All right. Because if we talk about it as a single person, then that's not for the spouse. There's not a spouse in here.
Gotcha.
So that's just, because you're tier 1, you're $20 copay on the most expensive plan, $40 copay on tier 2. 20 extra bucks. You went 5 times, you spent an extra $80.
Yeah.
Who cares? All right. You can see here as we start going down here, your screen for all preventative care is no charge on every plan. You didn't get any benefit there.
Yeah.
Diagnostic and labs. Okay. There might be some benefits here. Okay. So $10 copay opposed to a $20 copay.
Yeah.
Woo. You're spending $10 more for that copay. And then if you go to the ER, it's a $60 copay opposed to a $30 copay. Who cares? It's nothing. Urgent care visits, okay, you're cheaper, $50 opposed to $75. Again, who cares?
$25.
Emergency room visit, you're getting that cheaper. You're going to save a big $150 for walking in the.
If you're admitted, then it's waived.
Yes, then that's fairly typical. But their plans, that's what they're offering you. Outpatient surgeries. This one I would think would have a little stronger benefit, but nope. Look at they're all the same benefit. 30% at freestanding surgery centers, the physician's office, or 40% in hospital. They all are the same. So there's no better benefit. crazy. But where this does come into play is your deductible is higher. So when you have a higher deductible up here to $5,250, so this is where there is some more upfront benefit if you have a lot of outpatient surgeries. They're $3,000 here, $5,000 there.
Yeah.
But it's going to take a lot of those to make up the difference of what we just saw.
Yeah.
Right? Let's try to PSPRS, or if you're out there and you're listening to this at all, please, we'd love to get a representative to help spell out some of the details.
Go a little deeper into some of it. Yeah.
Yeah. I really am concerned about just saying the wrong thing, giving false information out there.
Yeah.
So, but I think you're in good shape, man.
Yeah.
What you need to be. That's good. Happy for you guys.